Welcome to the Gray Report. I'm your host, Spencer Gray, and we have another excellent episode doing another total recap of everything that happened in the multifamily industry, real estate, and the economy. So, if you are a multifamily investor, aspiring investor, you're industry insider, you are in the perfect spot. Again, we're going to be bringing on the Director of Communications and Marketing here at Gray Capital, Matt Bosnock. We're going to bring him on in a second. We're going to break it down. Again, a lot of stuff going on in the economy. Real estate, the multifamily market is more or less on fire, but there's all these concerns. We've got the Delta variant, roaring. People very concerned about that. Eviction moratorium still hanging over, and all kinds of crazy stuff going on politically in the economy. So, without further ado, let's get into it. Okay, Matt, welcome again. Awesome to have you back on as we have you every week, kind of breaking it down. Again, Matt's the guy doing a lot of research. He'll release kind of quarterbacking all this research that you're going to find in the Gray Report newsletter. It's going to come out every Thursday morning at 8:30. Hop on over to graycapitalllc.com/newsletter to sign up. But if you haven't subscribed to the Gray Capital YouTube channel, highly encourage you to do that. We'd really appreciate it. So, hit the subscribe button, give us a thumbs up, and we'd love to hear, get a comment from you. We'll respond, pretty quickly. We're pretty active on YouTube and anywhere else. So, come over and get in touch with us. But Matt, what's going on? How's the week been going for you so far?
Yeah, it's been going pretty great. I'm seeing a little bit of a light at the end of the tunnel. I think that there are some signs of strength, especially in the multifamily industry. This is strength, I guess, that's despite a lot of things and despite the rise in Delta that you kind of can't ignore. But the FDA passage, FDA approval of the vaccine, this promise of more stimulus, those are pretty significant signs of further growth on the horizon, for sure.
Yeah, it's interesting. I think, there's people who have a very short-term view on things and a long-term view, and I think that there's a lot of uncertainties. I've said this before. This reminds me of 2009, 2010, but I think there was a lot less confidence in 2009, 2010. But it's reminiscent of we've just went through some pain, and that's all I can think about is that pain. So I'm not confident about the future. But when I look at the long-term fundamentals, I think things are, we're relatively good footing. Obviously, we're still stacking on top of this house of cards we've been building. You could say since 2008. You can say we've been doing it since the early 1900s. So wherever you want to start the house of cards. But I think there's more the good than bad, even though there's concerns. So again, another excellent edition of the Gray Report. Let's get into some of these articles, Matt. I've got a couple of questions. I'd love for you to break them down. Let's just start super macro, political, whatever. We're not really partisan on this show or anything. We'll just kind of tell you straight up what we think. I mean, in general, we're investing in real estate, so we're capitalists. But I think Matt and I are pretty well kind of balanced, not really one side or the other. But anyway, so House adopts budget, greenlight reconciliation process, $3.5 trillion with a T in additional spending. Man, that's a big number. Big news. Nancy Pelosi made a deal with 9 moderate Democrats for infrastructure. They wanted to pass infrastructure before reconciliation, but it looks like they made a deal. They're going to get infrastructure done sometime in September, but they got at least this $3.5 trillion budget piece, at least kind of over another hurdle. And now I guess it's on to committees and the reconciliation process, which Matt and we decide we are not going to get into a process discussion because, well, we don't want to tell you the wrong thing. So, but Matt, what's going on? What's your thought? What does this mean for the economy? What does this mean for the multifamily industry?
Yeah, despite the Byzantine process questions that will rightfully avoid, the number is 3.5 trillion, and that's that's a very simple and easy number, easy thing to remember, more than the kind of hurdles that it keeps plowing through. I think that it is worth thinking about that complicated process and all of the checks that need to be voted on and all of the compromises that need to be made, but the number's still 3.5 trillion and it's still steadily moving forward. There are significant motivation to pass it, and there are the the term, what was it? Nine ironclad.
The nine, what was it? I don't know. Well,
They
the
had some kind
nine
of
moderate Democrats. Yeah,
the
it was
unbreakable nine may have
the
been.
unbreakable nine. The unbreakable nine. Well, they kind of gave in. Um,
Yeah.
so yeah, and the big thing is, I think that the number still could move from the 3.5 trillion. The big thing is, though, in the Senate, though, they only need simple majority to get this thing
Yeah.
passed. And so they don't need, I think they basically need all the Democrats, and I think they need one Republican. And so I don't think that they can get the 3.5. And again, not to get into the process, but long story short, like, let's distill this down. A lot more fiscal stimulus, a
Yeah.
lot
There's
more
an appetite
spending.
for spending. Yeah.
We're looking at 4.5 trillion between the infrastructure bill and this the new reconciliation, the new budget. Now, the $1 trillion infrastructure package, that's not necessarily all the new dollars. I know they're reusing some of the unspent funds from some of the prior COVID bills that were passed in 2020, but still, it's a lot. It's a lot of fiscal stimulus. It's a lot of spending, and we're already seeing relatively high levels of inflation. And what I'm relatively concerned about is really labor. I mean, the labor shortage. I mean, it's been bad.
Yeah.
It just seems to get worse. I mean, like, just anecdotally, everyone's seeing this. I mean, help wanted signs everywhere. Businesses shut down because they don't have anyone to work, or just one person, or they're just people are hiring whoever they can get. So it's like people don't even know what they're doing. You go out to a restaurant and they don't know what they're doing.
We talk about inflation, and I think that's the kind of unspoken effect that this is going to have. This will cause some amount of inflation because there's going to be more money that is pumped into the economy. But then the question is, if this money is directed towards lower income people, then it may be a net effect. However, typically inflation does seem to affect lower income people more than higher income people. So they're going to have to do the work to make sure that who needs this money gets this money. Now, in terms of housing, there is, and this is just an early breakdown that it will likely change, but 332 billion for the banking committee, which includes investments in public housing trust fund, housing affordability, and equity and community land trusts. There seems to be a lot of room to pick and choose in that 332 billion. So I'm not sure how direct that is going to go to housing projects. Mm-hmm. However, there is going to be a direct carve out for housing in that bill, which is nice. And we may speak about this before, but it seems very important to get this money directly to renters, directly to the housing market, and whether that's increasing supply or giving people support for housing, because otherwise, if you try to do this the stick approach rather than the carrot, it may just kick the can down the road. It may not alleviate the problems as much as it just kind of extends them.
Yeah, I think that's a good point. I mean, $332 billion for housing. I mean, that's not a small number. I mean, I mean, that's like a third of what we spent on the Iraq War, basically. I mean, that's a lot of money. And so, yeah, it'll be interesting to see how that's broken out. More money for affordable housing, housing trust fund, equity and community land trusts, and general investments into public housing, which we have a major housing crisis. So we definitely, as much investment into housing in general as we can make would be ideal, whether that's private or public. Although the government, they're pretty bad at that, but that's why they let private developers do it now, because they couldn't figure out how to provide housing. So again, not being political at all there, but you can read between the lines.
It is interesting that that the support, that there is a way, it does seem to make government support and government support of housing work for the private sector, because I don't see a whole lot of of government built multifamily buildings.
They did it in the 60s and 70s. That's the projects that you see, they're crumbling and being torn down, or misused, they've been mismanaged, and it's not good stuff. And they gave up. They figured we can't do it. We have to have some public-private partnerships and have the private sector do it. Let's talk about the Delta variant, because that in a very weird way, we talked about it last week. Somehow it relates, in a sense that and we talked about this last week, if we don't want things to run too hot, inflation to get too much where that purchasing power is absolutely destroyed, we get over our skis, more infrastructure, more spending, higher inflation, is the silver lining of the coronavirus sticking around with us a little bit longer than we would like? Is it a regulator on
Yeah.
the amount of growth? What do you think?
I think a lot of this depends on vaccines. I've still and there is going to be uncertainty associated with the Delta variant, regardless of the vaccine. But I do think that that the FDA's approval of the vaccine removed a stated objection. Now, some people may be using that as an excuse and may just move the goalposts. But companies have certainly used this as a real threshold. And what we may see happen is vaccine mandates from companies convincing people to get the vaccine.
Yeah.
This will likely be an outlier, but it could result in slightly less uncertainty because the virus is less of a risk. Even if Delta is still a risk, it's less risk if you have the vaccine, and that could mean a little bit more stability, but also a little bit more growth and more risk of an overheated economy at the same time.
Yeah, I'm curious because I think what you said is probably the case. I think there's probably going to be mostly goalpost moving of like it's not approved. Well, now there's going to be another reason that's wrong with it. But I think to your point, though, that the employers have a lot more sway over just saying that it's approved. And so if your employer is saying, hey, look, you need to get vaccinated, people don't want to lose their jobs. And I think some people are diehard. This is the hill I'm going to die on.
And you know what? A lot of people will take an action and then justify it rather than have a principle and be dictated to it.
Yeah. Seriously. So, I think some people are going to get it. Some people are going to get the vaccine now because of this, between being approved and employers. I think a lot of people have decided they're not going to do it now. It's such a principle thing based on not a whole lot of good information. And I think these people, I think it's social circles. It's a social pressure either way, whether to get vaccinated or not. If you're in a circle that's everyone's vaccinated, it's like, why the heck aren't you vaccinated? But if you're in a social circle where everyone's like, hey, no, I'm not taking that. Like, if you heard what they put in those things. But here's my takeaway though about the vaccine or the Delta variant. I don't think that it's going to matter that much in terms of the economy and opening up. Maybe people take a slightly less action. The people who are going out there doing things, being out there in public, are going to keep doing that. If you weren't going out already, you're going to continue to stay in home. But the fact is, we've got a supply side issue. We need more supplies. The demand's there. The demand's not going to slow down. Whether people are or continue to order things from home, people are still going to be going out. I don't see huge lockdowns happening, at least in the United States. I know there's lockdowns in Australia or something going on in Australia that looks crazy, but I don't see having lockdowns. I don't think economic activity is going to be severely slowed. And I think we're going to get through this Delta variant, and there may be another variant, but I think that we're going to get through this.
In short, I think that the engine has definitely started. It is well into recovery. Delta seemed like there is a threat, there is some uncertainty, but it is significantly less. And we have a lot more tools to treat and to vaccine against the threat than we did a year ago. So
Yep. 100%. Okay. Enough politics, enough COVID, vaccine. Let's get back to multifamily. That's why you're here. That's why we do this. But again, got to have a sense on what's going on in the economy. That's why we bring this stuff up, how it relates to multifamily. I mean, we get a little bit of get a little macro sometimes. I think that's okay. Hopefully you enjoy it. Give us a like, comment, tell us if you don't. Hey guys, stick to what you know. Stop talking about whatever. Okay, eviction moratorium, eviction pressures abating as economy, labor market continue to improve. Matt, this is a brief from Marcus in Millichap. What's the deal? I haven't read this yet.
So this is stuff that we have probably covered a lot of it in previous weeks, and we did cover it in these videos and in the newsletter when Biden did extend the eviction moratorium. this does add some kind of useful context and puts things into a little bit of a perspective in terms of how rents are behaving. Delinquent rental payments have really not been that far off of pre-pandemic numbers, like the 2019 numbers, a couple percent lower, yes, but still in like 95, 96%, and nowhere near the levels that they were at in 2020. It's hard, and I mentioned this before. It's hard not to think that there is a political element at play here. Again, I'm not going to dip into it, but when it comes to jobs in the economy, the lower unemployment rate means more people should be able to afford housing, and the low vacancy, high demand environment that this article, that this research brief mentions, has really pushed rents higher for classes, including the Class C tier, where the risk of coronavirus related eviction is the highest. So there are people that are willing to pay for these apartments. The pool of these renters that is able to pay has increased, and that is driving the rents higher, not because of not because of pressure or anything like that, but because these people are getting more money so that they are more able to pay. I do think, the stated risk is the rise in infection rates. But like I mentioned, it seems more easy to issue the eviction moratorium extension than it is to pick through this $47 billion in rental assistance. And I wish it was as easy to give the rental assistance directly to, and I mentioned this before, the rental assistance issue is particularly interesting because one of the ideas behind the initial pandemic stimulus was to get the money out quickly.
Yeah.
Maybe some people are going to get it that don't need it, but you can't put too many barriers up because otherwise the people who do need it won't get it. Well, now you have a backlog of rental assistance cases in the courts, and courts do a lot more than rental assistance cases. But there are a lot of these barriers between this money and the people who need it. And I just wish, it's interesting how different this philosophy is when it comes to housing. And housing seems to be this one crisis that is not going to go away after the pandemic.
100%.
That's my spiel.
Yeah, well, the problem existed before, not enough housing, and we still don't have enough housing. Household formation is up, and we don't have that much more supply. And when during the pandemic, the idea was, helicopter money. That was the plan. Just money into the system everywhere. Everyone's getting money. If you're a business, here's a big grant. Whatever you can make up. We're not even going to check it. Here's a $1 million. Here you go. Then for everyone else, you get a stimulus check. Let's get the money out. And again, coming back to, I think that this is like a dry run for some kind of universal basic income, and like it's cheaper probably just to give everybody money than it is to go through this process.
Yeah.
That's my estimation, and I think that's going to be. I think that's only going to drive growth. It like sets that floor. And it has all the other issues that we mentioned earlier of, creating, removing that rung and not allowing people to build wealth, grow wealth. But I think that a case could be made. You just give people the money. You just, if you're making below X, then you just get money, and there's no application. It's just you get a check. And I think there's a lot of economic arguments, not political, not moral, I think there's a lot of economic arguments for the benefits of that. There's also some severe, and I think the benefits are short term, and then I think that there's some major dangers for the long term. I think there's moral hazard. I think that there's you create a lot of unintended consequences, and I think that you could, the fear is you see this runaway inflation, you see hyperinflation, and but I think, again, I think central banks around the world are practicing modern monetary theory without telling everyone that that's exactly what they're doing. And they see inflation pick up, and then they're going to raise taxes to tamp down inflation. Maybe they'll stop a little bit of the printing, but mostly they won't, because then they'll have absolute, riots in the streets. You can't cut the checks. You can't cut people off. They're going to be absolutely dependent on it. You create another entitlement, so you have to raise taxes. If we had a more sound monetary system, and a reasonable free market, I don't think we'd have these problems, but you'd have more pain. That's the thing. The goal here is, and we saw over the pandemic, we wanted to have no pain. Everyone's okay. Everyone's getting their check.
Mhm.
Everything's good. And you spread that pain out, or you kind of, you defer it. And maybe we can defer it forever. Maybe it's like a 1031 exchange. We're going to just keep kicking it, that can down the road, and then we'll all die. And then it'll be everyone else gets a stepped up basis or
Yeah.
whatever. But yeah.
Yeah, it seems like
Interesting times.
Yeah.
I don't know what else to say. Okay. National Association of Realtors. They've got a migration trends report from January through June. Yeah, I thought this was a little dry, Matt. But
Yeah.
I recommend everyone listening to us. And you can read it, tell me what you got out of this.
National migration trends are some of the most interesting trends to me because they're a compelling detail in so many of the narratives in multifamily and the economy. You can probably make a very good investment based on numbers alone, but the story of an investment is an important way for investors to interpret these numbers, like the story of a small town on the outskirts growing into a thriving suburb, the story of an urban exodus, or the return to downtown. This report, and Apartment List does similar good reports like this in terms of migration. This is good. It provides good numbers and figures to support a lot of these stories. In some cases, refute them. People who lived in the gateway cities were not necessarily moving out of town as much as they were moving into nearby towns and suburbs. It does say that fewer people moved this year than last year, but that doesn't seem to be a significant number. There are people now that are moving to less populated areas, to rural areas and smaller cities and towns. Breaking it down by family versus individual. Families tend to move away from the urban centers. Individuals tend to move to the urban centers. And the same thing, if you look at the cities that they're moving to, families move to places like Naples, Sarasota, and individuals move to big cities like San Francisco, Seattle, Denver, all these kind of bigger names.
Looking for jobs. It's either you're going to look for a job, or you're starting a family, or you are a family and you're trying to get some space.
Yep, more space for, and that seems to be the general throughout the whole population is, moving to less populated areas, more space for your money. One of the most interesting finds in this, and I'll be quick about it, is the business moves. With moves to, and now you see a lot of these big names like Denver, Phoenix, but the businesses moved to places like Bridgeport, Connecticut, Omaha, Nebraska, Cincinnati, Ohio, alongside the more typical areas in the Sun Belt. The upshot to all of this is, again, this movement away from the urban center to less populated areas, not in the exodus-like biblical terms that we were expecting last year, but still, this trend can be a helpful context for national trends as well as the trends within a specific multifamily market.
Yeah, it's all about catching the wind in the sails, go in the right direction, and if you can harness some of these migratory trends, then you're going to be just floating downstream versus paddling upstream. And so it's, especially if you are looking, you're not tied to like one specific market, you don't have a target market already, and you're trying to figure out, where do I invest, or which markets are worth tracking and kind of seeing what's going on. Looking at this migratory data, especially over a long period of time. And again, this all makes sense. Population is getting older. Millennials are a bigger percentage of the population. Then you got baby boomers. People like to have warm weather. So, the Sun Belt states are incredibly popular. But then there's others. There's more business-friendly states, tax-friendly states, and a lot of other, details.
Well, and that's what I wanted. To kind of emphasize here is that there are top performing markets, and sometimes the top performing markets will receive a lot of attention and a lot of competition from investors. Mm-hmm. And so I'm always drawn to those cities that you kind of don't see in every single, but then you notice them, and then you're like, well, this is great. And you're kind of not necessarily looking for a diamond in the rough, but you're looking for something that maybe doesn't have that competition, but still has a really robust numbers.
Those solid fundamentals, but it's easy to pass over for one reason or the other. And no, I agree, because the markets with the growth, that growth can be priced in, it can be overbuilt too. Now, in the long term, if you have a long-term investment horizon, you're going to be okay. But if it's shorter term, it can be tough. And conversely, you may, if these markets that aren't really growing that much, but they could still find great opportunities because there's niches, but maybe it's not a long-term hold. Maybe you want to get in and get out. There's a handful of markets that we've invested in that there was a need, there was an absolute need for the type of investment, but it's like, do I believe in this market or this location, this sub-market? Do I believe in it 10 years, 15 years out? No, the next 5 years we'll be fine. We know what the need is.
Yeah.
But I don't know if I'd want to hold this for for forever. And usually, and typically, I only want to invest in something that I'm okay with holding forever, but there are those kind of tactical opportunities out there that you come
Yeah.
across that, like I'm just thinking about a couple of deals we did in Muncie, Indiana, that, it's a stagnant market, a little bit of growth in some areas, decline in others, university town, and got in, got out, good mid-20s IRR after a couple of years, but I'm not looking to go back. So
Mhm.
cool. Okay. Let's just, we got one more report for everybody. And this is a question that a lot of people have had, and we've talked about this, kind of sort of given the answer, but I think it's worth mentioning that apartment list. It's a good report. So what is driving up these rent prices, Matt?
Yeah, if you
Rob,
followed this
Warnock,
video,
yeah.
we've covered these factors individually or in combination, really. They list 5 factors. More households are competing for homes. High home prices are leading some would-be homeowners to remain renters. And also more people are searching for apartments to rent. Just looking at like the Google search history. More people are urgently looking for an apartment compared to like kind of casually looking. And also vacancies are historical low. Now, these are the reasons that are cited from apartment lists. And I think that these data points instead kind of just serve to underline the magnitude. These could also serve as signs of the affordability crisis as much as reasons behind them. I think the real reasons behind them are in the final paragraphs of this report, talking about the generational shifts and the long-term trends that are going to come with the millions of millennials that are entering prime home buying years. Yep. This is just, and we mentioned the supply issue. We mentioned this, the increase in the recovery, and along with these huge, massive generational shifts, there is going to be, and another thing to mention is it takes a long time to build a multifamily building. It doesn't, these things are not going to pop up overnight, and it's going to take a little bit longer to build because of the labor shortages in construction. So I think that this housing demand is not going, even though it's slightly ebbing right now because of seasonal trends, I think that there's a strong case to be made that 2022 is going to be just as high demand for housing.
Yeah. Yeah. Because everyone took well, not everyone, we didn't, but everyone else took a hiatus last year. And if you were getting ready to start a project, you're like, okay, I'm going to hold off maybe a little bit. And so just projects were delayed in the pipeline. Like a lot of markets, like there's just going to be a gap in that pipeline because it takes, 2-3 years to get something, built from, buying the land, getting it entitled, all that. It's construction, lease up. And so it's gonna further, at the same time, demand's going up. It's a recipe for continued higher prices, lower vacancy. Now I will say, developers every time they smell blood in the water, we can overbuild, and we're seeing an incredible amount of building that was already going on in some of those gateway markets, kind of those headline markets that we were just talking about. Call it the Phoenixes, the Atlantas, handful of others, the Dallases. Now all those have super solid fundamentals, absolutely good markets, but where you're specifically going, which submarkets, which neighborhoods, make sure there's not too much oversupply of that certain class. Now, if you're getting to the B class, if you're B class apartment investor, workforce housing, value add, all the class A, maybe you're going to be okay. Unless the class A lowers their rent to compete with you. But if there's you've got a big spread between your rents and the class A, you're probably going to be okay. But if you're buying class A or you're developing, you want to be sure. But we need that kind of building too. We need that housing stock. So at the end, it will work itself out until it doesn't. and you can build too much. We saw it in 2008, and that was obviously a combination with loose credit and other systemic issues. But we leave it to developers, leave it to builders.
Yeah.
We can overbuild. Let's not mistake it. But
Yeah.
right now we're not. So okay, this was an excellent roundup, Matt. A good overview of what's going on, multifamily industry, real estate, the economy. I really appreciate, again, this is an excellent report. So if you would like to receive, we only touched a handful of articles. There's a long list of articles in the Gray Report newsletter, graycapitalllc.com/newsletter. And if you are someone who likes to not wait a whole week to kind of get the skinny on what's happening in the market, you're like, what are the updates? And I don't want to go to 5 different websites or 10 different websites or the dozens of websites that we track. Just go to grayreport.com. Now you can sign up for the newsletter right here by pressing this button, but we're updating the latest research reports, data, articles, all from the multifamily industry, commercial real estate, the economy. It's all right here. In addition to videos, okay, hey, what's going on, Brandon Turner? We've got all kinds of good stuff, whether it's from us, from others. We try to just have the best content. A lot of really good stuff on here. Again, macroeconomic news. It's just the reviews of what people are saying about the Gray Report. It's humbling to us, and we're very grateful for all the support that everyone's given. And again, what's going on? Just real quick. Obviously, we're not going to be able to do any technical analysis with these charts, but hey, just what's going on? Where is the S&P 500 today? Okay, well, we're up, but then it's flattened. Interesting. Commodities. We're not doing the markets and rate snapshots on these videos because it takes up too much time, but you can go on to grayreport.com. You can find out real quick. I mean, again, this is lumber over a year. It's really finally back, but it's still elevated. Man, it's amazing how much lumber has come down. You're not hearing about it for good reason. And really, man, we should probably do a whole thing on the fact that lumber has come down so much. But, other commodity, we don't need to do this right now. But grayreport.com, www.grayreport.com, AOL keyword, the Gray Report. We haven't added our chat room yet, or our guest book. We were gonna also get a counter, like a ticker, those tickers, Matt. That
people. Visitors.
Yeah.
Web 1.0.
Pre-beta. We're going back. We're going back. Yeah. We appreciate everybody watching this video. Again, please, if you could subscribe to the Gray Capital YouTube channel, that way you'll be you get an update as soon as these pop up. And you give us a like, give us a comment saying, hey guys, I like your insights, or tell us, shut up with your insights. I don't want to hear it at all. Tell us about this and that. Get into the research reports. We don't want you pontificating, opining on what the House and Senate are doing, or you're like, no, guys, your analysis is the analysis that we need, that we've been looking for. Maybe that's true. I think it is. Matt, again, thanks so much for being on the Gray Report.
Thank you.
We'll catch everybody next Thursday for the newsletter, and these videos come out Thursday too, usually too. Matt, we're really on top of it.
Indeed.
So next Thursday, this Thursday, every Thursday at 8:30 later in the afternoon for the videos. graycapitalllc.com, grayreport.com. Sign up for the newsletter. We'll see you next week.